All right, business terms. So here's what we're going to cover. We're going to cover just the bare minimum of business terms that you must know. And so the first one is gross sales. Gross sales is the metric for the total sales of a company, and it's calculated as the total sales before discounts or returns. Net sales. Net sales is your gross sales minus any deductions, such as discounts, returns, or allowances. As an example, let's say you do $500,000 in gross sales. Gross sales is also known as just sales. So let's say you do $500,000 in gross sales, but let's say you had $25,000 worth of discounts because you sent out some mailers or some coupons. And so the actual amount that you've received is your net sales. That's the $475,000 in net sales. Now, gross profit. This is a term you'll likely hear often. Gross profit is the profit after deducting the costs associated to making and selling its products or with providing its services. And so if you take your net sales and you subtract your cost of goods, otherwise known as COGS, that equals your gross profit. Now, some of you guys may be familiar with some of these terms from the corporate world, or if you went to business school or something like that. For me, I never got a college degree. I was not familiar with those sort of terms. I was in the personal finance world. And so these are important terms that you need to know. And so as an example, if McDonald's does $10,000 in net sales, again, after discounts, returns, etc., and all of their food cost, paper cost, straws, etc., cost them $3,000 to produce that, then their gross profit is $7,000. Right? The $3,000 would represent their cost of goods, their COGS. Now, profit, aka EBITDA. So EBITDA is a term that you will hear often. It essentially is your profit. So the term profit is really vague, and it's not the technical business term. The term you really need to know is EBITDA. What does it stand for? Earnings before interest, taxes, depreciation, and amortization. So, EBITDA is meant to show the cash profit generated by your company before debt payments, taxes, and other items mentioned. Let's say you have a business that makes $100,000 in profit, aka EBITDA. That's what shows in your profit and loss statement. Well, if you have a loan on the business that you pay $24,000 a year, aka $2K a month, you may pay $10,000 in interest for the year. I'm just making a random number up, right? And so the business made $100,000 in profit, but your loan payments don't reflect on your profit and loss statement, although you typically are able to write off the interest paid on your tax returns. So although the business made $100,000, you take home $76,000. Does that make sense? Because of the $24,000 in your debt payments. Then you still need to pay taxes on the money that you made. Now, sometimes you can write off depreciation on your taxes, which doesn't come out of your bank account, right? Depreciation is just writing down the value of assets, but then you can deduct it on your taxes. So if you have a vehicle in your business that's worth $50,000, and at the end of the year, it's only worth $40,000, you write off the $10,000 in depreciation and you pay less taxes. So these are all the other things that are factored. Again, earnings before interest, taxes, and depreciation. If you take your earnings and then you start taking all these things, your debt payments, your depreciation, the interest, all of a sudden, technically, when you're doing your tax returns, although you may have made $100,000 in profit, maybe your taxable income for the business might only be $50,000 or $60,000, if it's all making sense. The main takeaway here, though, is understanding what EBITDA is and isn't. It shows you the profit from the business, but it's not the full story in what you actually take home from your business. Now, you can fill in the blanks later. For now, you know enough to get started getting your hands dirty. Now, these are some of the basic terms that we just covered. Next, we'll dive into the opportunity of franchising, exactly who's buying into franchises and why.